Hi, I'm Pattu from freefincal. Today let's talk about market timing. If we invest in the Nifty only when it was low, can we beat the market? So many investors, probably because of the small amounts that they have actually in the market, they believe that they can do portfolio rebalancing by just adjusting the investment amounts. They believe that they can do market timing by just adjusting the investment amounts without actually changing the amount of equity that they hold. For example, if the market is overvalued, they feel that they don't need to remove the equity that's invested in the market. They can just adjust the investment that's being done in the equity and the debt portfolio. This is quite silly, and there's really no basis for that, and we are going to try and dispel some of these myths today. So some definitions. Beating the market can mean getting more returns than the market. Let's say Nifty, getting a lower or achieving lower risk than the market, or a combination of the two. Now, for most people, market timing actually means getting more returns, but we have shown again and again and again. I have some of these videos as well, that getting more returns from market timing is more or less a coin toss. Sometimes you will get it, sometimes you will not get it, if the sequence of return is right or wrong, what we call as timing luck. But what's more likely to happen is you will achieve better risk management by market timing. So we are in this article, I don't want to get into the risk management part. We just want to find out whether we get a more return or not. In particular, if we get a more higher corpus with in terms of market timing or not. And we will define the Nifty low in terms of we are going to compare the current price of the Nifty with respect to the 180-day exponential moving average of the Nifty. If the current price is lower than the 180-day exponential moving average, we will call it as low, and if it is higher, we will call it as high. Now I have a Nifty index valuation tool which you can use to evaluate the stock market, whether it is expensive or cheap, in multiple ways. So let's now consider a daily SIP of rupees 100, which is not too much, and we're going to look at so a daily SIP investment in this context means daily we will be investing rupees 100 in the Nifty total returns index. The expense ratio is not included in this argument. We will also not take into account taxes. Then we will have another kind of SIP, or called the Nifty is low investment, or invest when Nifty is low. This means that I will invest into Nifty TRI only when the Nifty price is lower than the 180-day exponential moving average. If the price is higher than the 180-day exponential moving average, I will invest in a imaginary debt mutual fund that gives me a constant annual return of 8%. Again, there's no tax. Nifty is high investment is just the opposite of this. I will invest into Nifty only when the Nifty price is higher than the Nifty 180-day exponential moving average. If the price is lower than the 180-day EMA, I will actually invest into the debt investment. So it's a counterintuitive investment that we're going to talk about. So basically, I had asked the Facebook group Awesome Ideas of Wealth, if I compare the daily SIP versus investing in Nifty when it is low kind of SIP, between June 1999 to May 2020, which would do better? Perhaps because of the market crash, many investors, as many as 145 members, said Nifty is low. That is the market timing, that is investing when the Nifty is low investment, would do better than the simple daily SIP. Only 81 members said the daily SIP would do better. So that's essentially what a market crash would do to you. By doing a daily SIP, we are basically tracing the Nifty, and because of the market crash, people have thought that if I trace the Nifty SIP, Nifty from June 1999, it would not give me a return more than 8%. So, but that's natural. I mean, that's what happens. That's what a market crash actually does to you. So let's take the first graph. Here you see the daily SIP is in blue, and the buy when Nifty is low SIP is in green. Again, buy when Nifty is low SIP means when Nifty price is lower than 180-day exponential moving average, I will invest in Nifty total returns index. If the Nifty price is higher, I will invest in a imaginary debt instrument giving me constant 8% return. So you can see that it has not outperformed. Naturally, the volatility is low, but that's natural. You can't. So now let us compare buy when Nifty is low SIP versus buy when Nifty is high. That is, I'm doing something counterintuitive. I am buying when the Nifty is supposedly high in valuation. If I do that, you can see here the red line which has been added is the buy when Nifty is high, and the blue and the green line is Nifty buy when Nifty is low. There is practically no difference between them. People who understand momentum investing will know that why the red line is actually doing reasonably well, because you are tracing the momentum. You are investing when the Nifty has the upward momentum, and that's the reason why you are able to get reasonable returns. And that's a close up of both. You can see buying when Nifty is high has actually done well since December 2015 because the market has moved up, and you can see this for crashed and so on, but that's fine. But that's actually counterintuitive. Most people cannot accept this. They think they have to invest only when the Nifty is low. For then if they invest in dips, then there are a lot of gyan will be there in all these YouTube videos without any kind of back testing. Without, you should do market timing. You should invest. I have been following dip investing. It is giving me more returns. Bullshit. Show me data. Show me proof. It's just nonsense. I'm just getting tired of people who go on social media and say this is better, that is better, without any kind of evidence. It's just moronic. So like I said, I told myself I won't get angry, but it's very hard. When I think about investors, I automatically become angry these days. Buy when Nifty is low. I know that sounds horrible, but that's it. That's how it is. Buy when Nifty is high, it does just as well as buy when Nifty is low, but that's because of the momentum involved in it. Now, I have backtested 10-year daily SIP versus buy when Nifty is low for about 2,706 times, and you can see practically all the time the daily SIP has done better, except for during this short period when the market actually crashed just for a few runs for a few days. The buy when Nifty is low has done better. Other than that, the daily SIP has done well. This may seem counterintuitive to you, the reason being that we are not doing any kind of proper tactical asset allocation. If you want to do market timing, you must do proper tactical asset allocation, where when the Nifty is overvalued, you should remove money from your equity investments, put it into fixed income. Then when the Nifty is undervalued, according to your definition, you should remove from fixed income and push it back into equity. If you don't do this, there's no chance for you to efficiently lower risk. There's practically zero chance of you getting higher returns than a simple SIP. Don't say if you do monthly it will be better and so on. No, I have done all this. I would strongly urge you to go to freefincal, go all the way to the menu, go to this free stuff right here. If you just go to this free stuff, there is a link here that says market timing. If you go to that, that's an archive of all the tactical asset allocation backtests. I have pretty much done every backtest that you can think of, using the Nifty P, using the Nifty PB, using single moving average, using double moving average, using the Motilal Oswal movie index, using momentum. Practically all these backtests have been done. Of course, there is limited data for the Indian scenario and so on, but these backtests have been done, and I suggest that you first have a look at it, and please don't go out there and say that will work, this will work, without showing any kind of proof. It's just horrible. I've seen YouTube videos where people are saying, do this when Nifty is down 10%, 20%, do this, do that. Where's the data? Where's the rigorous analysis? Please recognize that when I show you this graph, when I show you a graph like this, this is just one data point. What I mean by one data point is, I am showing you one sequence of return between June 1999 to May 2020. That is one data point. I have to roll this sequence of return over every day or every month, and that is what I have done. I have rolled it over for over 2,706 10-year periods, and I got this data, and I show you a daily SIP practically almost always wins. So please, unless you do some rigorous analysis, don't go around saying this is better, that's better. when you do rigorous analysis, you recognize that nothing is better. Sometimes that will work, sometimes this will work, and that's the problem with being open-minded. Anyway, so I'll catch you later. Bye bye.